All right, so the last topic of this discussion is going back to section 721, the general rule of non-recognition of gain or loss when a partner contributes property, right? That has an inherent gain or loss in there, right? Remember, it's gain or loss. A property, it had to be property. But what if you have services? If you have services, that rule does not apply. That general rule of non-recognition. Now, if you do have services, if you are a partner that's contributing services in exchange for an interest, you have to distinguish between a capital and profits interest. So first, before I give you the rules, the distinction, I want to distinguish what they are economically. A profits interest just means that you do not have any capital when you receive the interest, or ever. So if there's a hypothetical immediate liquidation, a profits interest holder gets nothing because there's no liquidation value. Versus a capital interest is the opposite of that. You actually have a capital balance. You have to contribute capital. So a profits interest means that, okay, when the partnership gets profits later on in the future, you're going to share in those profits. A capital interest means that you do have a capital value, so you have to share profits and losses, and upon liquidation, you actually do get your capital value back. So those of you that are accounting students out there, you might remember that for partnership accounting, when we allocate liquidation, the last step is always based on capital. Now, historically, there's been some changes in the law with respect to this. There was a Diamond case, a case called Diamond and Campbell, which talked about you had to distinguish between the two. And the Rev Proc did the same thing. And both Rev Procs, they did the same thing. Now, Rev Proc 2001-43 also said that a Section 83B election. Now, Rev Proc 2001-43 basically came in and said that you don't have to do a Section 83B election. I don't want to get into that. That's a little bit beyond the scope of this. But I just want to mention that. So the current rule is under the proposed regulations. Now, I know they're proposed, but that's the safe harbor that we use. And the proposed regulations do not distinguish. They treat capital interests and profits interests the same. So they do not distinguish. So there's not a distinction. So the reason I brought up the distinction earlier is because, again, the rules used to be you distinguish, now you don't. So proposed regulations would reverse the rule, but allow a safe harbor. So we use these today, even though they're proposed and they're not final regulations, because it's a safe harbor. They came about in the 2000s. So we go ahead, we don't distinguish between capital and profits interest. We go ahead and we include the value at the time it's received at its liquidation value. All right? So the important part here is that a capital interest, when received, is basically going to be its liquidation value. And there's other ways to look at this, which the regulations specify. But that's generally speaking going to be the hypothetical liquidation, what you would get if the partnership liquidated when you receive the amount. Now, the partnership gets a corresponding deduction with respect to paying for these services. Just so you know. And that's important. Now, that's for capital interest. For a profits interest, as I said, a profits interest under the definition economically, there is no liquidation value. No liquidation value. So when a profits interest is received, the general rule is that you include nothing. But you do include profits, so we include profits as they're received. So basically the profits interest holder would include profits as received, but when the profits interest holder receives the actual partnership interest, they do not have to include that value because the value is going to be zero. So it is a taxable event, but it's going to be zero. Now, there's a few times where the value is actually going to be not zero. So if you go back to the previous slide, we still apply the rules of Rev Proc 93-27, where these three, a substantial certain income stream, it's sold within 2 years, or a limited partnership interest in a publicly traded partnership, these things actually will have value. A profits interest, so the term for profit in economics is pi. Profits interest does have value. So that would be a value. So where it's not zero. So I'll put does not equal zero. You actually have to value it. So substantially certain income stream is where there's like a partnership that might have like a really long, like a 20-year lease and like real property, and it's had that for a long time. It's very secure. So within 2 years, so you basically have to go back to your year and you have to amend it. And then limited partnership interest, there's a value on that. So that's the key, is that profits interest is hard to value. It's all about valuation is the key. Valuing. Valuation is tough, right? But in certain cases, it can be valued. So I'm going to go ahead and stop there. Again, the Section 83B election portion is something that an advanced topic you might consider, but I'm not going to discuss it here. So that really ends the discussion of contributions to partnerships.